Financial freedom starts with passive income that pays your rent. In today's fast-paced world, securing a reliable source of income can feel like an uphill battle. As expenses pile up and the pressure to make ends meet intensifies, one expense stands out like a recurring nightmare: the monthly rent. But what if there was a way to turn this financial burden into a thing of the past? What if you could find a smart solution that not only covers your rent, but also provides a steady stream of income? What if there was a way to invest that has your rent paid like clockwork every month? Sounds amazing, right? Well, get ready to explore a simple and smart investment option that can make your rent worries a thing of the past. In this video, we will show you the ultimate secret to making your rent disappear with 6 monthly paying REITs that work like magic. In the end, we'll show you how you can minimize the risks and still earn over $10,000 a month. John, having successfully saved $100,000 through a wise investment decision, is now ready to enter the next phase of his life, a rent-free life. His goal is living off the dividends generated from his investments. Determined to make his dream a reality, and with $100,000 in savings, John embarked on a quest to find the perfect investment opportunity: REITs that pay monthly dividends. But before that, we need to know, what are REITs and how do they work? REITs, or real estate investment trusts, are a way for people to invest in real estate without buying properties themselves. Instead, they can buy shares in a REIT and become part owners of a group of properties. These properties can include apartments, offices, shopping centers, hotels, and more. REITs work by pooling money from many investors and using that money to buy, develop, or manage different real estate properties. The money generated from renting out these properties or selling them is then given back to the investors as dividends, similar to profit sharing. By nature, REITs are required to pay at least 90% of taxable income in the form of dividends. This has helped REITs become well known for their reliable and often higher than average dividend returns. Now, let's take a look at John's picks for the year in terms of REITs, starting from average but safe returns to slightly riskier options with excellent potential returns. Starting at number 6 is Gladstone Commercial Corporation, known by the ticker symbol GOOD. This is our first pick on the list. It pays an annual dividend yield of 9.4%. Based on this yield, if John invests his $100,000 savings today, his investment will generate an impressive $9,400 yearly. But let's take this a step further. John has the luxury to wait 5 more years. So John decides to reinvest his earnings and wait those 5 years. By the end of year 5, John's investment will be valued at $159,706, paying him an annual dividend of $14,275. That's about $1,190 per month, which meets John's target of monthly rent. And here's the cool part: GOOD pays its investors a monthly dividend. The dividend of 9.4% that they pay is really high compared to other companies. That's way more than what you usually get from regular stock market investments, which only give you around 1.6%. The reason they can hit that high yield is because they own a lot of properties, about 137 of them in 27 different states. These buildings are rented out to more than 100 different tenants from various industries. By having a mix of different types of buildings, they can make sure their investments are spread out and not all in one place. This helps reduce risk and makes it more likely that they'll make more money in the long run. To top it off, what sets them apart from others is that the company is really good at finding tenants, and most of their buildings are almost always occupied, with a current occupancy rate of almost 97%. This means they can collect rent and make money consistently. Next, at number 5, we have SLR Investment Corp. Known by the ticker symbol SLRC, this company offers an amazing opportunity for people who want to earn extra income. This REIT offers a very respectable dividend yield of 11.25%. This means with a $100,000 investment, it can pay up to $11,250 annually. By choosing to reinvest these dividends for 5 more years, John can watch his investment grow to $175,046. This increased value would then generate an annual dividend income of $18,543, which is about $1,545 per month. What makes SLRC special is that it's a trustworthy company with a diverse portfolio. They invest in different types of businesses, like those focused on cash flow, assets, life sciences, equipment, and corporate leasing. By spreading their investments across various industries, they reduce risk and increase the chances of making good returns. What truly sets SLRC apart is its commitment to providing investors with substantial monthly dividends. In fact, they've been consistently paying dividends since 2010. That's 13 consecutive years of paying dividends. While past performance cannot guarantee future results, SLRC's portfolio has weathered the challenges of the past, and its diverse holdings position it for potential growth. Next at number 4, we have Ellington Financial, known by the ticker symbol EFC. This is a highly favored REIT among investors looking to diversify their portfolios. With a dividend yield of 13.5%, EFC offers a tempting opportunity for investors looking to boost their earnings. Based on this yield, John's $100,000 investment will earn him $13,500 annually, or $1,125 per month. This means John doesn't have to wait for his investment to pay off his rent. But if he waits for another 5 years, his investment will balloon to $195,664, paying him an annual dividend of $24,580 or $2,050 a month. With an extra $500, John can now not only pay his rent, but also be able to pay off some of his utility bills too. While it's important to be cautious of high-yielding stocks, EFC stands out as a reliable choice thanks to its unique business model, growth potential, and commitment to dividend safety. So how do they do it? Let's break it down. EFC combines the benefits of owning properties and investing in mortgage loans and securities. Their investment portfolio is diversified with various loans, including jumbo and manufactured housing loans, to mitigate risks and shield from interest rate fluctuations. Now, here's the exciting part. EFC has strong growth prospects. The main reason? EFC has managed its debt well compared to other companies in the same industry. This means they're in a good position to handle both good and bad economic conditions. Now we move on to some high dividend yield and slightly risky territory. To avoid this risk, stay with us till the end, where we will show you how you can receive higher payments and also enjoy lower risk with a portfolio. At number 3 is AGNC Investment. Known by the ticker symbol AGNC, this REIT stands out with an extremely high dividend yield of 16.6%. That means that with $100,000, John can earn $16,600 annually, or around $1,383 per month. But here's where it gets even more interesting. If John keeps his investment and reinvests for the next 5 years, his initial investment will be worth $228,031. That's more than double what he put in. And on top of that, he'd be earning a yearly dividend of $34,658, which means he'd be getting around $2,888 each month. Unlike other companies that own physical properties, AGNC specializes in mortgage securities. These are securities formed by grouping together home loans. Investors like John earn from this when homeowners pay their monthly mortgage payments. To stay on the safe side, they invest in safe mortgage-backed securities that have government guarantees. This means they face less risk compared to private mortgages. The important thing about this REIT for investors is that AGNC has a great track record when it comes to paying dividends. Since they started, they've given shareholders about 4 times the value of the current stock through dividend payments. This shows their commitment to rewarding investors. While the higher dividend yield is tempting, it comes with some drawbacks. Rising interest rates can be a challenge for mortgage REITs like AGNC, but they've managed to perform well in the past. As interest rates fell, AGNC benefited from stabilized spreads and economic earnings. Getting back to our list, at number 2, we have Orchid Island Capital. Known by the ticker symbol ORC, this REIT pays an above-average dividend yield of 18.73%. That's an annual dividend earning of $18,730 from John's $100,000 investment. Even without reinvesting, he can get up to $1,560 per month. But what if John waits 5 years and reinvests? After 5 years, John's investment will grow massively, up to $253,265, paying him an annual dividend of $42,954. That's around $3,580 per month. This means after paying rent, John will have an extra $2,000 that he could use for paying his utilities and maybe even some nice things for himself. It could be like having a little luxury or something special. ORC is a unique investment opportunity for someone like John. It's a specialty finance company that focuses on residential mortgage-backed securities, or RMBS for short. In simple words, these are debt instruments backed by residential loans like mortgages. Although RMBS can be volatile, ORC has historically benefited from falling interest rates, making it a potential winner in a declining rate environment. And just like our previous high-paying investment opportunities, these REITs can have a risky side. For instance, rising rates can pose challenges for mortgage REITs like ORC. While there are risks to consider, the potential returns offered by ORC's dividend more than make up for it. Take into account the volatility in past dividend cuts, but also consider the attractive dividend yield and the unique market niche in which it operates. In the end, we'll show you how, with a portfolio, you can avoid this risk and still get paid with high dividend yield. And now we move on to John's top pick of the year. At number 1, ARMOR Residential REIT. Known by the ticker symbol ARR, this is a mortgage real estate investment trust, in short, MREIT, that offers a fantastic 19.28% dividend yield. Before calculating how much John can earn from this REIT, let's see why it was John's top pick for the year. ARR is different from traditional real estate companies because it focuses on investing in residential mortgage-backed securities. These are loans backed by government-sponsored entities like Fannie Mae and Freddie Mac. What sets ARR apart is its consistent monthly dividend payments. Of course, there are risks, such as the potential impact of economic downturns and market volatility. It was very much evident during the COVID pandemic, which had an impact on ARR's performance, but the trust managed to meet its financial obligations and maintained access to financing. It showed resilience during challenging times, which is what investors like John look for in a REIT. Now, how much can John earn from his top pick? With $100,000 invested, it can pay up to $19,280 every year. And in John's case, after 5 years of reinvesting, his $100,000 investment will grow up to $260,215, paying him an annual dividend of $45,300, or roughly $3,875 per month. With all that additional income, John can now afford to upgrade to a new and more luxurious apartment without any concerns about paying the rent. This financial stability gives him a sense of security, like owning a house. Now, maybe like John, you don't want to expose yourself to that level of risk, but also don't want to miss out on a higher dividend opportunity. So what should John do? Well, here's how John can have the best of both worlds by making a portfolio. For his diversified portfolio, John distributes his investment in all 6 REITs. We know Gladstone Commercial pays an annual dividend of 9.4%. SLR Investment Corp pays 11.25%. Ellington Financial has an annual dividend of 13.5%. AGNC Investment pays a good dividend of 16.6%. Orchid Island Capital pays an excellent but risky dividend of 18.73%. And lastly, ARMOR Residential REIT with the highest dividend of 19.28%. By taking every REIT into the portfolio and dividing it by 6, you get an average return of 14.79%. Based on this yield, if John invests his $100,000 today, he will earn an annual dividend of $14,790 or $1,233 per month. In 5 years, that same investment will massively grow up to $208,544, paying him an annual dividend of $28,508, or roughly $2,376 per month. But what if you wait even more years? Using the same diversified portfolio, in 10 years, the investment will grow to $434,906, paying an annual dividend of $59,452. In 15 years, the same investment will be valued at $906,970, paying an annual dividend of $123,985, or $10,332 per month. This is how reinvestment works. But can you earn $5,000 with only a $1,000 investment? Watch our video on the dividend snowball to know the answer to that question.